Did you know that you can now do a mini IPO known as a Regulation A+ and raise up to $50 million to capitalize your real estate deals or even your company, and that you can advertise the whole thing online? My guest today is Rod Turner, founder, chairman, and CEO of Manhattan Street Capital. He is the oracle of all things Regulation A+. Welcome to the National Real Estate Forum Podcast, episode 203. Thank you for joining me today. I am Dr. Adam Gower, and this is the Crowdfund project at nreforum.org, where developers, investors, and industry leaders share insights that you can use to raise capital and invest in crowd-funded real estate deals. In today's episode, I get into some of the nuts and bolts of Jobs Act Regulations A+ and CF. Regulation A+ is sometimes called the mini IPO for your deals and allows you to raise up to $50 million in any year. And Regulation CF, which stands for crowdfunding and allows you to raise up to $1 million in any given year. While very different in scope and requirements, both regulations are being used by real estate developers to raise capital for their deals. And they both open doors to almost anyone who wants to invest in real estate, no matter how little they may have to invest. If you want to become an expert in raising money and investing in real estate deals by crowdfunding, then you are in the right place, here at the National Real Estate Forum. I have compiled a high-level summary of the key features of crowdfunding real estate that you can access completely free at the nationalrealestateforum.org website, nreforum.org website, nreforum.org/primer. Rod Turner is founder, chairman, and CEO of Manhattan Street Capital. He is a serial entrepreneur with multiple IPO exits to his credit, including Symantec, which is probably the best known. Rod is a recognized expert in crowdfunding, most particularly of Regulation A+ transactions. It is an area in which he has encyclopedic knowledge, as you shall hear.
I first came over to Los Angeles, West Los Angeles. Then I switched over to my first startup company about a year and a half after I came to the States, which was a company called Ashton Tate that made a database called DBase. DBase 2 and DBase 3 was when I was there. And I was the 12th employee. We became the third largest microcomputer software company, public on the NASDAQ. I was VP of sales at the time. It was a lot of fun. Fantastic. More than a lot of fun. It was a fantastic journey, tremendous experience, and really the first time I'd learned a lot and been really challenged every day in my career. That was, transformative for my career, big time. Then I moved to Northern California for Symantec, where I was one of the earliest executives there, executive VP of product management and marketing and sales and international. And we took that company public some years later, about 6 years after the Ashton Tate IPO. I was the general manager of the largest product group. At that time, we had divisionalized the company. Anyway, so that took me to Northern California, and then we bought a company within Symantec. I moved back to Santa Monica because we acquired the Peter Norton utility company, and I ran that merger, that combination, which was a huge challenge and a tremendous success for the company, for all involved. It was a really fun experience too.
Now, you've done some startup work as well, haven't you, in more recent years?
Yes. So those were startups, and then I did a company called Knowledge Adventure. I was CEO, and then more recently, I helped build some companies. I went through a phase where I was mentoring others, where they were building companies, and I was assisting them, putting together the team and guiding them and so forth. And in some cases, helping them raise money. And then in 2011, I've done I played a key role in building 6 successful startup companies altogether so far. And in 2011, I started work on a company called Start.ac in crowdfunding business, because that's what you could do in 2011, 2012. And focused on raising money for companies and charities because Kickstarter didn't do either by donation, crowdfunding, with a deep model and a lot of sophistication to it. It failed, but I learned a lot from the experience. And because the Jobs Act was launched or announced at the same time as I launched my company, Start.ac, that was interesting timing, and it primed me to pay attention closely to the whole of the Jobs Act and, look for opportunities and help companies along the way here and there to utilize some of the new things that came as a result of the Jobs Act.
Yeah.
And then in March of 2015, when Title IV Regulation A+ was announced, after a week of studying it, I decided that this is a tremendous opportunity. After a week of studying it, I decided that this is a tremendous opportunity for a company to do what we do in my company, Manhattan Street Capital, as a funding platform for Reg A+ companies. And as an industry, startup, actually really mature startups and mid-stage companies. The biggest opportunity is for mid-stage companies that are too big for VC and too small for private equity, and they're too small for an IPO in the way that IPOs have become more restrictive since 2001. So Reg A+ sits in a place that is really needed for some really strong companies to raise sizable amounts of growth capital. That's why I launched this company starting in the first week of April 2015. We went live in mid-May under the name Fund Athena initially, and then renamed the company Manhattan Street Capital in August of 2015.
All right, so let's back up a little bit. Yeah. Real estate is a ancient industry and seems to be ever so slowly moving into the 21st century. And so this whole area of crowdfunding is very interesting. Let me ask you this first. What exactly is the Jobs Act? It stands for Jumpstart Our Business Startups, right? Can you tell me a little bit about the Jobs Act and its different components, particularly as it refers to... Yes.
Yeah. So essentially, the Jobs Act, I'll talk about it in the sequence with which things have developed and been made effective. So the Jobs Act's intention was to make it easier for small companies to raise capital, which is a very laudable and needed improvement. Then, and as a result of that, then Jobs Act was announced, I believe it was March of 2012. So the first effective component was, it's called Title II, went effective in September of 2013, and it extended Regulation D to allow companies to market themselves to raise money from accredited investors. So Regulation D is as it always has been, limited to accredited investors only, and simply what the Title II did was expanded and allowed companies to promote themselves and to promote and for platforms to form that would promote their offerings to accredited investors only.
Okay, so let me jump in there. Let's talk about Reg D just for a second. So Reg D, so I have these two components of Reg D. There's Reg D 506B. These two components of Reg D. There's Reg D 506B and Reg D 506C. Is that the distinction that we're making? 506, as I recall, Reg D 506B limited the number of accredited investors that you could have in a deal, but Reg D 506C, the upgrade, if you like, allowed two things. One, it allowed unlimited accredited investors, and two, it allowed active solicitation of accredited investors that you did not previously know.
That's basically correct. So there are some nuances in Reg D that do restrict the number of accredited investors depending on the specifics of the structure and approach that a company is taking. But broadly speaking, the big difference is what you said. 506C is better and worse. At the same time, as you said, a company is allowed to promote itself to people that are accredited investors, and it's allowed to promote itself to investors in general, but only allowed to accept investments from accredited investors. So you don't have to, prove that a list that you buy or rent or have only includes accredited investors. So that's pragmatic. You can market an offering broadly on the internet. That's pragmatic. Obviously, you can only accept investments from accredited investors. The thing that 506C requires, though, is that the issuer, the company raising money, must take reasonable steps to verify that the investors are in fact accredited. You can't take their word for it. In 506B, then in that case you are limited to soliciting from people that you know. And there's nuances to that, but basically you have to know them to be able to approach them, so it's very limiting when it comes to promoting an offering. And you don't have to prove that they are accredited. If they say they're accredited, that's enough. They have to sign off on it, but that's enough.
And wasn't there also a limitation on the number of people, even if they were folk that you knew who are accredited, that you could put in a deal?
Yes, but I'm not familiar off the top of my head on the number for 506B.
But there was a limitation, right?
Yeah.
And on C, there's no limitation.
I believe you're right, but there are constraints on C where, depending on the nature of an offering, you have to be careful about that. It isn't a broad strokes with no limit in every circumstance. Okay. Most circumstances, that is true.
Okay, now did Reg D 506C, this upgrade, if you like, to the way you approach accredited investors, did that come out of the Jobs Act, Rod?
Yes. So that's part of Title II. There's a series of other changes that were made during this entire journey, but when we're talking about Reg D, this is material change, yeah.
And then the area that I know you specialize in, which is Reg A+. Can you explain a little bit about what that is, please?
Sure. So Reg A+ was made effective in July of 2015, and it took the old Reg A and expanded upon it dramatically. That little plus sign kind of understates how much it changed. So, with Reg A+, private companies can raise money privately, and they can raise up to $50 million a year, and in some cases more, specifically in real estate cases, more by doing multiple offerings simultaneously for different. There's two types, a Tier 1 and a Tier 2, which I'll get into in a moment. And the major issues are that investments can be accepted from investors worldwide of any wealth level. They don't have to be accredited anymore. And when they state their income and net worth, and if they're accredited or not, the company selling its stock is allowed to take their word for it. They don't have to prove what the investor states. So investors anywhere in the world can be accepted at any wealth level, and the SEC considers those Reg A+ shares sold through a Reg A+ offering to be liquid for the purchasers of them. So if the company doesn't lock the shares, then the shares can be traded someplace, depending on whether the company lists, where it lists, or whether it provides some other form of liquidity. So company doesn't lock the shares, then the shares can be traded someplace, depending on whether the company lists, where it lists, or whether it provides some other form of liquidity. So what you have in the high-end case is you can take a company public to the NASDAQ or the New York Stock Exchange using Reg A+, which is a private offering until the listing occurs, and then it's a public company. And you can use it to just raise the money and list on one of the OTC markets, like the QB or OTCQ or the OTCQX, with reduced reporting obligations. Because obviously, if you list on the NASDAQ or the New York Stock Exchange, then you have a full-on S1 level reporting obligation, which is very expensive and difficult to live up to. So companies that don't want to take on that burden can list on one of the OTC markets. And even if you have the option of using a redemption system, as has been done by some real estate companies raising money using Reg A+. So I would say those are the big picture aspects of it on the positive side of the balance sheet. On the negative side, it's expensive to do it because you have to make a filing with the SEC, which takes about 60 days when handled properly. And you have to pay an attorney to provide that service, which can cost, $50,000 and up, depending on the complexity of what you're doing and on what service provider you use. So that's a front-loaded cost. You've got marketing preparation expenses. And if it's a Tier 2 offering, you need to have an audit that goes back as long as the company has existed or 2 years if the company has existed more than 2 years. So those are the downsides. Upfront cost, and it's not a certainty that you'll be able to raise the money, which is basically true with any kind of capital raise in more than 2 years. So those are the downsides. Upfront cost, and it's not a certainty that you'll be able to raise the money, which is basically true with any kind of capital raise. There are no guarantees.
Now, but in comparison to doing an IPO, it's significantly less expensive.
Correct.
On the one hand. And secondly, for a real estate company, it's a novel approach to raising capital.
Yes, this is for sure the case. And I think the point that I want to emphasize going into this is that, as is the case in Title 2, which we touched on earlier, real estate has become a very large part of the whole, for a very large segment of Title 2 capital raises. And that's happening and happened already in Reg A+. Real estate is by far the largest segment so far of succeeding investors would like to own more real estate but don't have the time or enough capital set aside to do so. And many of these offerings are paying out a reasonable dividend or a preferred return, which is also very appealing in today's low interest environment. So, whereas in many other aspects of Reg A+, it's hard to get investors to pay attention unless they absolutely love a company. In the case of real estate, we as an industry have some sort of a critical mass going where regular investors are regularly investing in Reg A+ offerings because of the things I just described.
Now, can you describe the kind of characteristics that a real estate company would have that would be suitable for a Reg A offering? Well,
yes. So, as I see it, I break the companies down into two categories. Of course, to do a Reg A+, the fact is you're dealing typically with thousands of investors. And as I look at this, I see that as being a lawsuit risk in the future for companies that do not deliver or overpromise. So any Reg A+ offering must be conducted with great care. And, basically anything that's risky, overly risky, shouldn't be done using Reg A+. And if there's any kind of loopholes in an offering, if the team isn't robust, if the business model is too risky, if the risk of failure is too high, okay, you can cover that legally with the risk clauses in the offering circular, that is filed. But nevertheless, I think that if the risk is very high, it'll be difficult to get a platform like my company, Manhattan Street Capital, or a broker-dealer or other platforms involved because they see the risk exposure. And of course,
but they also want to be sure to have a successful raise.
Yes.
Right.
Yes.
So the kind of characteristics I'm talking about, for example, a Reg A+ is not for a sole developer that's got a deal in town that needs to raise some money for it. This is for established, experienced teams that have a track record that they can demonstrate not only to the market but also to folk like you and broker dealers.
Yes. You're putting that well. Yeah, you're right. So from that point of view, because you cannot in general A+, then you are restricted to what is the track record of the team. okay, you can describe the market that you intend to invest in, and if it's a robust market that's prospering and looks like it's going to continue to prosper, that's a positive. You can describe the size of the market, but you cannot make predictions beyond that. So the quality and the track record of the team in this entity or in prior entities, is intensely important to make it attractive to all participants, right? So, as you say. So, and if it's too small an offering, because of the upfront costs to do a Reg A plus, you should be really $200,000 is kind of the low end. It might get a little lower than that, and in terms of upfront expenses, that acts as a filter. But you don't want to do it for a small raise. So if you're raising less than, I would say, $4 million at the minimum, you should do it for that potentially. But the point is that, like you're saying, if it's one developer with no track record, then it's very risky. If the scale of the raise that makes sense for an offering is too small, then the upfront expense versus the upside is reduced. I mean, the ratio is skew-whiff, where you've got too large of an upfront cost to justify potentially. So that ends up being a screening factor as well. So in a way, if you look in the industry, you see Fundrise. They're using Reg A Plus as a completely central part of their platform. They have 3 parallel Reg A Plus offerings going on simultaneously, because you can do it, but you can they've divided the US into 3 geographic regions, and they can therefore raise money simultaneously for each one, raising up to $150 million per 12-month, raise money simultaneously for each one, raising up to $150 million per 12-month window, effectively.
Well, that's 50 million per geographical area, right?
Yes, that's right. So, but the point here is that they're doing a lot for smaller offerings. So a company that is a real estate developer that wants to raise a smaller amount can go to Fundrise, and they may invest in that transaction. So for smaller raises, I see them as a viable route to take, depending on whether an offering sort of fits their model, because they are raising a lot of money and they are investing a lot of money into offerings on a continuing basis. So to me, it makes more sense for larger offerings. We're working on some much larger offerings where there's no way that the company involved would want to be a part of someone else's thing. They want to do
down on this idea, because there are a few different scenarios, it seems, that you've described. One is where you have a company like Fundrise, for example, that it sounds like they're aggregating smaller developers' deals, presumably adding layers of screening on top of it, but using a Reg A plus to generate
investment capital.
Investment capital from the market. And then their platform is or their business model is to say, we are going out and finding developers out there with good deals that we screen, invest in us, and we will aggregate your investment across, however many deals with a certain investment strategy. That would be scenario number 1. Scenario number 2 would be where you have an individual company that has its own deal flow, internal deal flow. Is that correct? Where they're trying to generate, would be where you have an individual company that has its own deal flow, internal deal flow. Is that correct? Where they're trying to generate capital for their own internal deal flow. Say, for example, you have, I'm just guessing, for example, you might have a senior housing company that's got a great track record and 15 sites across the country that they want to develop, and they want to generate some capital for that. So they're not going out to third-party developers, they're doing it entirely internally, but they can use a Reg A plus to do that.
Yep, absolutely.
Okay.
Yes. So we have one company we're working with that's Southern California based that has more great development opportunities than they can fund, and they're using Reg A plus they are in the process of developing a Reg A plus offering in order to expand their reach, because they have so many great opportunities. And we have another one in Asia where they are establishing their U.S. headquarters establishing their legal headquarters in the U.S. so that they can do a Reg A plus offering for their Asian operation and their U.S. operations. And they are doing a similar thing. They have a tremendous market and they have tremendous opportunities before them, too much to capitalize through their other approaches. And in that case, they're planning a large Reg D because it's quicker, followed by a large Reg A plus, and intending to follow that with a series of Reg A pluses that they'll operate in parallel.
Now, are those for deals in the U.S. or for deals in Asia?
In the Asian company's case, both. They are doing both. If you're an offshore company and you want to use Reg A plus, then you need to establish your legal.
You can find a summary and a full transcript of today's episode in the show notes at nreforum.org/Rod Turner.
Now, do Reg A plus issuers have skin in the game? Do they invest their own capital, or is that a case-by-case basis? Is there any? Presumably, there's no requirement to. But right. What are you seeing in the real estate space?
So there's no actual requirement to. What I'm seeing generally, I've invested in limited partnerships in real estate, residential and commercial developments over the years personally. So I'm experienced in living it that way, right? And what I'm seeing is very similar structures being used, where the investment vehicle itself is, instead of typically a partnership raising the money or a Reg D raising the money, they're using a Reg A plus fund. So you have a general part where the investment vehicle itself is, instead of typically a partnership raising the money or a Reg D raising the money, they're using a Reg A plus fund. So you have a general partner and you have, different service providers being paid in similar ways. Typically, the fees are somewhat lower because the scale is larger, so the fees can be lower on a percentage basis, whilst being larger, I suppose, on a dollar basis. But the point is that the structure is very similar to what developers are used to. It's just that the money-raising engine is a Reg A plus with its nuances.
Right, and so from an investor's perspective, perhaps the biggest difference between a Reg A and the old way, if you like, right, is that you don't necessarily know the sponsor, the developer, personally.
The investor doesn't.
Yeah, the investor, right. The investor, right. So with all the LLCs that you've invested in, I'm guessing, are through friends and family. Presumably is that you don't have to invest as much, right? There's a minimum threshold.
A lot less money in, that's true. To me, that's a huge advantage. Putting my investor hat on my own personal investment hat, I like that diversification. But, the other thing is that while what you're saying is exactly right, you don't know the people. One of the big concerns about the Jobs Act from before the get-go was that there would be, rampant fraud.
Abuses, right.
Abuses, yes. And that so far has not come to pass. And I didn't expect it to be a problem because the nature of this online offering model is so transparent and so public that, when you've got hundreds of thousands of people examining an offering and examining the social media profiles of the principals on a transaction.
That's a really interesting thought.
Thousands of people examining an offering and examining the social media profiles of the principals on a transaction.
That's a really interesting thought. Go on.
It's so easy for somebody that says, that guy who calls himself Joe Smith. He wasn't called Joe Smith before, but he was involved in something else that I didn't like how it went down. It's so easy for somebody to point that out, and then the word to spread. I think, frankly, it's like surveillance cameras in a neighborhood. Puts off the thieves because they'd rather go somewhere else where they won't be recorded. And in a similar way, the transparent access that we have through online funding platforms is really good. It makes it
all right. So look, I think that's an extremely interesting insight. It's like crowd-funded reputation as well, right?
Yeah.
However, let me ask this of you, though. This Reg A+. And
then the SEC was rather slow in implementing the different phases of it for their own reasons. But, it's been sequential availability There's another component of it which went effective in June of 2016, which is Reg CF, raising up to $1 million
right.
capital, all wealth levels, illiquid.
So let's have a chat about that in a second, but let me ask you a question about Reg A. I would like to come back to Reg CF in a moment. But so, kind of pursuing this idea that the world is different today and that you have reputations exposed online because of social media, etc. But if Reg A+ has only been active since, say, 2012 or 2013, one big thing has not happened since then, and that is a downturn in the real estate market, which we all know is an absolute inevitability. Mm-hmm. What do you think the impact of that is going to be? Do you think these are inherently different types of investments in real estate than, the country club, friends and family type of investment because of that kind of exposure, or do you think there are still the same kinds of risks involved?
I think, I guess that the inherent risk of is it going to succeed or fail is the same. I don't think it's really changed much by, you could make a case that because it's theoretically easier to raise larger sums of money, there might be some more spectacular failures. And there is a risk of that always, right? But the process by which you complete a Reg A+ is so thorough, the upfront costs are significant enough that it puts off a lot of the companies that are not as so thorough. The upfront costs are significant enough that it puts off a lot of the companies that are not as substantial. And you've got, I do see a risk at this stage where because companies can conduct a Reg A+ offering on their own without a platform like mine involved, without a broker-dealer involved, then there are some companies that, I haven't seen this in real estate actually, but there are some companies that are raising money at excessively high valuations with questionable business models where you look for the substance and you don't see enough there. So I am concerned about that, but I think over time that will self-correct where investors will either just look at it and say, this is, as more sophisticated investors start accepting Reg A+, then they'll only buy into the transactions that have more substance. But also as companies that do filtration and selection, being broker-dealers and platforms, will become a more central part of the whole picture as a result of that. But there's nothing inherently different, in my view. It's different character. You've got, obviously, what you were saying, you don't know the people in person. But, having done a lot of real estate investments, the fact that I knew the guys doesn't mean that it was going to win. You know what I mean? It's like...
Well, that's right. I mean, that's kind of the point I'm making, is that maybe even a higher risk, right? If you don't have a crowd-funded oversight in a way of a deal. Let me just ask you another question about Reg A+. It seems to me that if you're raising $50 million, that's not friends and family level, right? That's way beyond. I mean, maybe between, at the high end, 5 to 10 million, you might just be able to cobble together friends and family. But once you start getting above that level, and certainly up to 50 million to 10 million, you might just be able to cobble together friends and family. But once you start getting above that level, and certainly up to 50 million in equity investment, that's traditionally been the realm of the institutional investor. Is Reg A+ taking them out of the picture, do you think, and replacing them with small investors?
Yeah, I think so. It's just a different animal that we're experiencing now. The quality. Go ahead.
Well, I was just going to say it seems like it's the institutional investors would take a very great detailed look at a sponsor and at their capabilities and have multiple layers of not only due diligence but also management oversight on top of that on an ongoing real-time basis for any sponsor. Whereas with Reg A, you don't have, presumably that layer has been removed. Now you're investing directly in the company itself, and so although you have all these small investors, do any of them have the same skill set that an institutional investor would have? And another question actually is, are you seeing any institutional investors investing through Reg A's in sponsors?
So the nature of Reg A Plus today in general is that we are not seeing very much investment activity from accredited investors or from institutions. In fact, very little from institutions and not much at all from accredited investors. Real estate is better in terms of accredited investor involvement, but mostly we're seeing consumer investors that just didn't have a chance as this company is funding, building, making happen. And we're seeing the next sweet spot is people that aren't accredited. They've been frustrated for years because they were almost wealthy enough to be permitted to invest in neat opportunities that their buddies who are accredited have been doing for a long time. So when somebody puts in a larger sum, it's more often than not somebody that's not quite accredited, in my experience. So that's a factor. But, the problem with this, and it's less obvious in real estate because we have a more balanced mix of investors in real estate. The problem is that it is very much more biased to individuals who don't necessarily have the experience or the wherewithal to do deep due diligence. So I see that more as a risk with other Reg A Plus offerings than real estate, but it is a risk in real estate because institutions are virtually not touching them at all unless it's an IPO to the New York. That more as a risk with other Reg A Plus offerings than real estate, but it is a risk in real estate because institutions are virtually not touching them at all unless it's an IPO to the New York Stock Exchange or the NASDAQ, and even that's just starting as we speak. That's literally the chicken soup for the soul offering IPO a few weeks ago to the NASDAQ was the first that I'm aware of that actually received institutional investment. So because of that lack of involvement, you're right. Now, having said that, the SEC goes through these offerings with a fine-tooth comb to make sure that they are real, that the companies are real, that they are legitimate. They're not validating the merit of an investment by any stretch, but they are, when they qualify an offering, they're essentially saying this is a legal entity, that it does exist, that is real. And, so there's that quality seal, if you will, at some level, and there are the pluses. You're right. My biggest concern for any Reg A offering is the ones that are taking advantage of the fact that if you've got something really appealing to consumers that really motivates them to invest, you can get away with an excessive valuation, which, is absolutely the wrong thing to do because you'll piss off those investors later on when they realize they were burned, but they didn't know up front because they weren't savvy enough to know. Yeah. So that, and of course, if an investment or an offering is inherently risky and it's being and it's able to raise the money anyway. So yeah, I am worried about that, and I don't see a magic solution beyond checking to make sure that a credible platform and or a broker are involved.
Well, like with anything, you can't invest anything more than you can afford to lose, right? Particularly in this area. Yeah. So let's just pivot to Reg CF for a couple of minutes. Tell me about that, and then give me a plug for Manhattan. Tell me what you guys do and how you make a living. Yeah. So let's talk about CF briefly first. What is Reg CF? Because that's the smaller end of the scale, isn't it? That is for the fix and flipper. Would that be accurate to say?
Well, yes, if it can be done in less than $1 million. So Reg CF is also known as Title 3, and it's the most recent of the significant Jobs Act announcements. Went effective in June of 2016. And it is really great for early stage companies because you can raise $100,000, $200,000, $400,000, up to $1 million in a very straightforward manner from wealth investors of any wealth level worldwide. You have to market the offering just like you have to market a Reg A Plus or any other online offering. It has to be promoted. But it's working well. I think Reg CF, is a very neat option. The only downside to it is that the company, once a company has completed a Reg CF, they have to produce an annual audit that is a GAAP level audit, which is more onerous than a typical audit. So I think,
and they raise their capital on an SEC approved portal.
Yes, on a FINRA registered portal, so a broker-dealer or a FINRA Reg CF registered platform, of which there are, I think, almost 30 of them.
Right.
Yeah, a lot of them. So then they have to live within, the way it works is that a company doing a Reg CF can only do it on a platform, and the platform can pick a platform, and the platform can pick a specialized area. They can say, we'll only do real estate, for example, but they are required to accept all comers. As long as it's a legal business, they aren't allowed to be selective, because you couldn't make them selective if you require the companies to have to go.
Okay, so they act purely as a service. They're a service for a fee, right?
Yes, various fee structures, but that's all regulated and it's all very reasonable, I think. You know, and you have the benefits of the open nature of that process. But basically, it's working quite well. It hasn't shot the lights out, but then these things never do, because, you know, it's a whole new game. People are learning the ropes, and the growth rate has been impressive in Reg CF and in the other aspects of Jobs Act as well.
All right, so tell me now, what does Manhattan do, and what kind of services, and how do folk get in touch with you?
Manhattan Street Capital, we are essentially two things in one. We are focused primarily on Reg A plus offerings. We will do select Reg D offerings where we can add value and where it's relevant. So a Reg D that's preceding a Reg A plus for a real estate transaction is a natural fit, because the marketing work you do in preparing and driving the Reg D flows a lot of that flows straight over into the Reg A plus to follow. You save money that way. So we do two things, though. We are a platform which enables companies to more easily raise money through advanced technology, and having a platform which enables investors to very easily invest, where we've got an extremely carefully designed investment user interface that makes it easy for the investors to complete the necessary forms and to complete the process for our offering companies. So we have that side. We do some really interesting things from a technology standpoint that are unique and will show themselves over time. In the platform, we have mentors, we have resources. We're building a community beyond just raising money, so that the community, my intention is that it will become more and more of a go-to resource for our companies to return to, and we intend our companies to be able to come back every year if they choose to do another offering. We want to make it attractive for them to do that. We're building a research analyst service for our companies that are listing their shares, to enable them to inexpensively get analyst coverage, for example. That's another thing we do. So then, the biggest of all of those things, the single biggest thing, is making it easy for investors to invest. Really making it easy, knocking down all the little barriers. By the end of this month, we'll be accepting cryptocurrencies as investments methods, so that expands the ease with which international investors can participate in a Reg A plus offering. That's a significant step up in convenience for non-US and US investors.
So let me jump back just briefly. You talked about analysts and being able to expedite analyst coverage. Is there any analyst coverage of real estate Reg A issues yet that you're aware of, or any of the other what would it be? Reg A plus.
Some in the offerings that are listing. So we've had 4 IPOs this year to the NASDAQ and the New York Stock Exchange, and at least 3 of them have analyst coverage.
Real estate. Those are real estate offerings.
No, I'm sorry. They are not real estate. None of them is. But they have analyst coverage because they're able to get them from Zacks and so forth. That's a good avenue. To get them from Zacks and so forth. That's a good avenue. In the case of real estate, I haven't seen analyst coverage yet, Adam. I haven't been searching for it. It may be there, and I invite people who are doing research analyst coverage on real estate transactions to join Manhattan Street Capital as a resource. and we'll be happy to make it easy for our companies to find them. Therefore, at the moment, that's a free service that someone can list themselves as a resource so that our members, companies can find them. Yeah. So going back to what else we do, we're essentially kind of like a concierge service where we introduce our companies to all the different service providers they need. If it's an auditor, or if it's a legal service provider, particularly the marketing agency, that's far more than just an introduction. We stay involved to help facilitate and make sure to maximize the sort of success of the marketing agency that we introduce so that our companies are most cost effectively promoting their offerings. You know, that is where the tire meets the road. It has to be done tremendously well. And then all the way through the back end, if a company is going to list, where they're going to list, the introductions, the market makers, the various steps that have to be taken towards the middle and back end of the process, the broker-dealer introductions earlier on as needed. So we do our absolute best to help our companies have great success because, frankly, being selective up front and picking companies that we believe have what it takes to be successful in a transaction and successful as entities thereafter, because we're all about building success within our investor community, so that my intention is that when investors hear about another Manhattan Street Capital transaction, they come right away and check it out because they don't want to miss out on a great deal.
It has built-in credibility. Now, do you have of course, you have a couple of real estate clients, right, that you're doing Reg A's for?
They are not live yet. We have two particular ones that we have more than two, but two in particular that are big and significant, that are relatively close. We have a real estate Reg D offering 506C that is live right now. On our platform, and they're virtually finished. They're raising, the minimum was 3.5, the maximum is 7.5.
And who is that?
Mark IV Fund is the company, and it's a residential land development in the Washington area.
Lovely. Okay. Well, so you know what? After, definitely send me a link, and I'll put that in the show notes for today's episode.
You bet. I'll be happy to do that. So, in terms of what we do, the concierge service. So basically, we are selective. We are selective. We don't do a lot of transactions. We don't want to do offerings that we think are going to be a waste of time and money. Why would we do that, right? So, and then we add a lot of value in the process to maximize the success level of those offerings all the way through, whether it's project management, reminders or introductions, or advice, where we're allowed to give advice. Because we're not a broker-dealer, we're not an underwriter, and we're not attorneys, so we don't give legal advice, we don't give valuation statements, and so forth and so on. But we do all the things we're allowed to do to help our companies succeed in their offerings.
Right, and you can certainly guide a real estate company through the process of getting a Reg A plus offering out there.
Yes.
And a Reg CF on a per-case basis, right? I mean, all on...
No, we don't do Reg CF. As much as I like Reg U, I don't want to lose the ability to be selective. And so simply for that reason alone, that's enough. And the other one is we aspire to appeal to the companies that fit the sweet spot of Reg A+, which are further along, making larger raises. And I don't think they want to be rubbing shoulders on one platform with $50,000 and $100,000 and $200,000 offerings, especially when they are not select.
Right. All right, very nice, Rod. It's been a real pleasure talking to you. Thank you very much indeed for your time. And if you don't mind, maybe you'll let me burn your ear again another time to do a deep dive on something as this podcast series gets underway.
Absolutely, of course. And my email is rodturner@manhattanstreetcapital.com. I'm happy to hear from people. And thank you very much for listening to this podcast. Turner@manhattanstreetcapital.com. I'm happy to hear from people. And thank you very much for listening to this podcast. And thank you, Adam, for making it happen. And I hope this has been helpful.
Rod's idea that the internet is self-policing and that this will mitigate the risk of fraud is intriguing. While this idea makes sense, I am not so sure. In many ways, there is just virtually no regulation of the space. If investors think that simply because others have dived into a deal ahead of them, that this somehow is social proof that a deal is worth investing in, then a lot of people are going to lose a lot of money when the cycle comes to an end. If you want to know more about online investing or how to raise money for your deals, go to nreforum.org/primer, and I will send you. I have spoken to guests ranging from crowdfund marketplace founders to venture capitalists to the first guy who ever invested in a regulation crowdfund deal. The next episode is with Ben Miller, founder and CEO of the marketplace platform Fundrise, and he is, quite simply, a tour de force. Go to the nationalrealestateforum.org website, nreforum.org, and subscribe at one of the links there so you don't miss an episode. And if you would like the free crowdfund primer that I've put together, you will find it at nreforum.org/primer. I really appreciate you tuning in today. Thank you. And thank you also to Rod Turner of Manhattan Street Capital for sharing your time with me today. Until next time, this is Dr. Adam Gower, signing off.